Here I am.
Back again.
Back again.
Guess who's back again?
That's the song. We're here at the Valentin Guzman Farmers Insurance, our new location, Karen.
Yes, we are located at 449 West 20th Place in Yuma, Arizona.
We've been around for a year now, Karen. Woo!
Woo!
Yeah, 1 year of insurance talk, guys, over 40 episodes. I don't even know what episode number this is. This should be like season 2, episode 1. So we're here with Alain Duron.
Yes, Alain Duron with My Yuma Mortgage. Before we get started, let me get some of the legals out of the way. My NMLS.
Hang on, guys, he's getting legal.
NMLS number 185183. My broker ID is 211844.
And what's your zip code?
I'm down the street, 85364.
All right, so we got all the legal stuff out of the way. We're here to talk about how interest rates are doing, Alain, and how it's a big thing right now. I'm not going to say it's a trend, but it's really big right here in Yuma.
It's a really big deal.
I've been seeing a lot here going through the insurance office, a lot of quotes for refinance. And of course, new purchases. The market is hot right now. A lot of people buying homes. Karen, you bought a home
Back in March.
back in March, right?
He helped me.
Right.
So you got a really good interest rate working with Alain, Karen. And another thing that you've noticed on your home, Karen, is that the value of it has gone up since you purchased it back in May.
Totally, it has.
Okay, so she got a really good interest rate back then. I mean, we're not going to go into specifics.
Right. Because, realistically, every situation is different. But if you know of anybody who's in real estate or maybe talking to your neighbors, you know that the market is really, really hot. And so what we're seeing is we're kind of in a perfect storm. Rates.
I like that, the perfect storm.
I call it the perfect storm.
Yeah.
Aaron, rates are at historic lows. Now, they were at historic lows about 9 years ago, and we took advantage of those, Karen. The difference this time around, though, is...
9 years ago, or?
Well, 10 years ago,
Okay.
when the big crash hit, rates came down.
And people started to buy again.
And people started to buy it, obviously, yes.
Yeah.
And in the course of that, the biggest difference between that market and this market is, back then, if you recall, prices were going down. Yeah, the rates were low, but they were low because they were trying to get people to buy.
They're stimulating us to purchase a home.
Whereas now, values are really, really high.
Wow.
Values are high, rates are low, and it's causing a perfect storm for us because even though prices are higher, it's giving you great buying power. Giving you great power when it comes to refinance. That's one of the, that's the hot topic today, is should I refinance? I would tell you if your interest rate is over 4%, it's worth having a conversation. Chances are it will be worth your while.
So if I bought a house, let's say 3-4 years ago, I'm more likely to have an interest rate around 3.5 to 4%.
Correct.
Okay.
And so some of the benefits with the higher values is if you're in a loan that currently has mortgage insurance, you might have enough value to be able to get rid of the mortgage insurance.
The PMI, right?
The PMI or the MIP, depending on what type of loan you've got.
People confuse that with the homeowner's insurance a
Right.
lot, but it's not. It's completely designed to protect the lender.
And it's mandatory, right?
It's mandatory in certain programs, and it's built into the loan. So, with a certain percentage of value, you can get rid of it. So that'll be instant savings. And then if we can tack on reducing your interest rate from a 4 to a 2.75, then
It's
you
worth
get
it.
then you get a big benefit. So then the other discussion I like to have with customers is, okay, so you get the savings. What do you plan to do with it? Because one of two things, right?
What are you going to do with the money?
Show me the money. So right, so you can save it, put it in your pocket, pay off some debt, obviously. But then the other thing is, my biggest goal is to try to get you to pay off your home sooner.
Faster.
So you can take that savings and throw that towards the principal, and all of a sudden, if you live in the house like you said, 5 years, so
And
got
you still
25
have 25 years left.
You take that savings, you throw it to the house, and you might end up paying the house in 20, 19, 18 years.
So I saved a couple of years of payments out of my pocket.
Yeah, and by doing that's really when, huge savings happens, because now you could be talking about saving yourself $30,000, $40,000, $50,000. I mean, not immediately now, but by paying
In the
it off
long run.
5-6 years sooner, it could very well be a big amount, and that's where it's worth your while
To refinance.
to refinance.
Because you're cutting your loan time down with a lower interest rate.
Exactly.
Because you took some money out to pay up those extra years.
Exactly. And by hopefully getting rid of the mortgage insurance if you've got it. Now, the other thing that we do when we refinance is pulling cash out. Now, I'm not a big fan of it.
I saw a lot of that back in 2007.
You gotta cash out.
I mean, the first wave where people would be like, "Oh, you know what? I have a lot of equity."
The SUVs.
They bought a boat. They paid off their
Side-by-side.
truck, and then the truck broke down a month later, but it was paid off.
Right.
But now they had to pay 30 years on that truck because
So-
they got added to their loan.
So, I'm a fan of pulling cash out if it's done with the purpose. Obviously, and everybody's entitled to their opinion, but number-wise, I don't think it's a good idea to pull money out, buy a boat, buy a car, buy a side-by-side. But if what we can do is
He's going to kill us on insurance.
well, I mean, because there's other ways of financing those that aren't too bad because rates are actually pretty good.
Exactly, correct. So you're better off getting a low interest rate on buying a new car or buying a Razor or a Can-Am or a boat than to paying it cash up front with the money you got from that refinance.
Right.
Okay. Makes sense.
But the other thing we can look at is, if you're drowning in some credit card debt, that's kind of the evil, right? If you've got high amounts of credit card debt, where we can take some of the cash out and alleviate
Those high
those
interest
payments,
rates and the
right?
high interest rates. Usually they're a little bit higher on the credit cards.
Exactly. They're a little bit higher on the credit cards, payments are higher. And then if we can take some of that savings and then throw it back into the house, then it's kind of a win-win. So I'll give you an example. I've got a customer right now where we're pulling like 30, almost 40,000
It'll cash out to about 40,000.
of equity from the house, and we're going to
Okay.
pay off credit cards and a couple of installment loans. And by doing so, we're going to get rid of about $500 a month worth of those debts.
Oh.
So
Okay.
his house payment is actually going to increase $100, but he's going to get rid of $5, so he's actually up $4. And so the strategy is take some of that money, some of that $400
That he's not paying on the credit cards
Right.
and then
so maybe you pocket 2 of that because now you're up $200 a month, and you take that extra 2 and you throw it to the house,
to the principal.
so that now the house can be paid off faster too.
Gotcha.
So it's kind of a win-win all around. And so, I mean, realistically, I have these conversations often with customers, and they say, well, my comadre said this, my neighbor said
El
this,
compadre dijo.
yeah, compadre dijo, my mom did this. And so the truth of the matter is, no situation is the same. Everybody's got a different scenario.
It's case by case, like you
It is.
said.
It's a custom fit. A mortgage should be a custom fit, and you should go to a custom fitter to fit you around. And there's a lot of people here in town that I respect that can run some numbers. There's also, what I'm not a big fan of is,
Let's just refinance because it's there.
right, because it's there, and then just
It's available, you're going to save a couple of dollars, but in reality, you're going to pay it. If you had a 20-year loan, now you're going to grow another 10 years on it because
Right.
you're up to another 30.
Right, I mean, you definitely got to go with somebody you trust and somebody that you feel comfortable with. I think that's the most important bit. And then just run the numbers. I mean, I always say, math is the universal language, and so the numbers don't lie. Show the numbers. You just got to be able to digest them to see if they work in your favor or not.
So-
And-
Perfect example. Let's say I bought a $100,000 home, right?
Okay.
I've been paying in for it 5 years, right?
Uh-huh.
5 years into it, I got an interest rate that was maybe at 3.5%, 4%
Okay.
5 years ago. Now the interest rate is as low as what, 2%?
on some 15-year loans, yeah, or like 30-year loans, they're in the mid-2s.
So if I probably haven't paid too much off on the principal on this home because I've only had it for 5 years. Would it be beneficial for somebody like me to do a refinance?
So first things first is on a $100,000 house. Truth of the matter is
They don't exist.
Well, hold on. So we need to do a responsible cost analysis because truth of the matter is if your house was $300,000, then I can make it look better because the savings would be greater. But chances are, if your balance is at 100, you would need a higher rate for me to offset the cost.
Okay.
The real answer to this, I don't know, that we would have to run the numbers. And because like I said, it's got to be real specific. And so
So-
we don't want to refinance you if there's not going to be a net value, then we definitely don't want to refinance.
If I'm not going to save a lot more money in the long run than what I'm actually going to pay out, because there's a closing cost and stuff like that when you refinance. And a lot of people don't take that into account. They're just like, oh, the interest rate's lower now. Let's go refinance.
So that's the part where we come in, right?
Okay.
And because when I look at a mortgage, the mortgage to me is like a race. It's a if you get a 30-year mortgage, it's a 360 lap race. And so, so you just recently started the race,
Yeah.
okay? So we're in, and so.
But she's gained equity since May, right?
No, March.
Since March, okay, but you've gained a lot of equity.
Gained some equity.
Yeah, which is good. Congratulations, Karen.
So when it goes to a refinance, so imagine, to me, it's like, it's really like a race. And so what we want to do is make sure that if we're going to start you over in the beginning of the race, make sure that we're going to bypass the position you would have been. So you're kind of racing yourself, right?
So you end up at a better place than when you started at.
Ultimately, but then the question is when. And here's the deal. So let's say your closing costs run $5,000.
Okay?
Okay?
That's a lot of money.
Well, depending on your loan balance, let's say I get to save you $200 a month.
200
All right.
times 12, that's 2,400 a year.
Correct. So right around 4 years is your break-even point, right? 4 years in a month.
Because of the 5,000 that
Perfect.
I paid in closing costs.
All right. So then if I'm refinancing you, and I know your break-even point at that point is a little bit over 4 years, my question would be, do you plan to keep this house this long? And if you tell me, yes, I plan to keep it, or no, we're considering selling, then we're having a different conversation.
Yeah, so what's the point? I mean,
Right.
you're going to put $5,000 and I'm
But
going to
if
sell
there-
it, yeah.
But the thing with time and the thing with people buying homes is you can kind of plan out the next 3 to 4 to 5 years. I think beyond that it starts to get foggier. So we don't like to see break-even points beyond 5 years because I don't think there's anything that guarantees that you're going to be in there yet. Your immediate planning probably you can guarantee as well. Yeah, I think I'll be there 3 or 4 or 5, right? And so if your break-even point is close, then we'll talk about that, and then we know it's worth it.
When am I going to start
Right.
gaining from this investment that I did? Because it's an investment.
Correct.
Even though you're getting a lower interest rate, you're still investing money out of your
But let's
pocket.
take that same scenario, Aaron, and let's go with, say I was only saving you $50 a month, and your savings was $500. So now we're 100 months out. Now my
Yeah.
question is, do you think you're going to be in the house 9 years?
Yeah, that's a little.
Right?
yeah.
And so then, as it gets foggier, then, I would talk you down from refinancing because your break-even point is that far out.
9-10 years from now.
But the beauty behind, with these rates right now, though, is with the rates being so low, the savings is greater than normal. And that's why right now refinance is so popular because the numbers just prove it to ourselves that
Like you said, it's a case-by-case basis.
case-by-case basis.
If I owe 100,000, it might not be in my best interest.
So
It depends.
If you owe 100,000 and your interest rate is like a 5, then it's worth having a conversation. If you owe 200,000 and your interest rate's a 4, then it's worth a conversation.
Okay.
So because realistically,
The higher my interest rate is and the lower the principal is a big
so
thing.
so the higher the balance is, the bigger a small change in rate is going to affect.
not
The
that
lower the balance is, the less of an impact the rate's going to have. Although it sounds nicer when I had a customer who wanted to refinance and he had like a 6% rate, and I'm like, and his balance was like $50,000, and I kept telling him,
Yeah.
let's not refinance. And so I think his savings was, after closing costs, was $10, $15. And he says, well, let's do it. And I said, look, it doesn't make sense because
Yeah.
your break-even point is like 8
You had to pay
years
clothing
for
costs.
$15. I go, no, I'd love to do it. And I talked him down from it. And then he finally understood. But he just, he
Elaine,
wasn't-
you would make the worst car salesman ever.
No, I mean, I just try to, I'll tell
But
you this.
you're looking out for the best interest of the client. I mean,
Yeah.
you're sitting there and you're doing the numbers. In the end, it's their decision, right?
Exactly.
But you try to set what's going to happen and how
Right,
long
and-
it's going to take.
And I'll tell you one of the things, and one of the things that I shared with you when you're doing a loan, like, I like to put myself on the other side of the desk and he
Put yourself in their
instructed the
shoes,
way-
yeah.
He instructed the way I would like to receive the information. So, I've been doing this for 20 years and it's a way that's worked for me.
Woo, 20
So,
years,
20
Elaine.
years, yeah.
Wow.
How was your experience over there?
It was very smooth. We closed within like a month and a half. What took longer was for the seller to leave than for us to close.
Couldn't get the seller out.
Couldn't get the seller out.
Are closings that quick right now?
No,
or?
so as this big perfect storm, one of the problems it's created is there's a lag. And so our biggest detriment right now is the appraisal turn times.
Okay.
And so here in town, all lenders share appraisers basically, because they're subcontracted.
Is it one appraisal company?
No,
or-
there's a handful, but at the end of the day, we all end up using, it's Yuma, so we
Okay.
all end up using
The same
the same
one?
appraisers. So our turn times are very, very similar. And so appraisals right now are taking, where they used to take 2 to 3 weeks, they're probably at 4, 5, 6 weeks.
Oh, wow.
And so what used to take 30 days is taking 45 to 60 days. And so it's kind of it's not a bad problem to have. It just means you're busy. It's not a bad problem to have.
But there's, unfortunately right now, like I said, is it a buyer's, a seller's market? It's more of a seller's market right now, or?
Well, so we
The interest rate is good, right?
Interest
That's
rate's
awesome.
good. And so one of the things is, again, it's a personal approach, but I'll tell you, my personal feeling is, and I shared this with you previously,
yeah.
is I think houses right now, because of the seller's market, are high. You're gonna see that. Prices are high. But when you look at when you run the numbers, all these houses are affordable and surprisingly more affordable than people think because the rate is so low. So I ran some numbers for a customer not too long ago where we looked at the possibility of waiting. They asked about, hey, what if I would just wait to buy a house? Because in their eyes, the house was
Too expensive.
was overpriced like by $40,000. So curiously enough, I ran the scenarios, and keep in mind, I'm not a real estate agent, but I'm of the feeling that these values aren't just going to drop off overnight.
No, there's not gonna be like, hey,
And so-
election day and all of a sudden you lost 40,000.
Exactly. So it's going to be a gradual change. So if in fact, so we had that conversation, if in fact you feel the value was 40,000 inflated, how long do you think it's going to take to, and so we threw an idea out there, and he seemed to think it was going to be 2 to 3 years for the values to drop.
Okay.
Well, in the course of that happening, if the interest rate changes 1%, which is, that's a real number, it's
Yeah,
likely.
it's plausible.
It might even change more than
Yeah.
that, but it's plausible.
Yeah.
It's not outrageous. So realistically, in his case, if he waits 2 to 3 years for the sales price to drop, yet the rate increases by 1%, it would actually give him the same payment, or roughly about the same payment.
Wow.
So then the net of waiting would have actually, on a month-by-month basis, would have yielded in nothing. In the meantime.
Because he's paying rent
Because he's paying rent, he's paying this, right.
and he's not putting
Not
money into the
owning
principal.
anything.
Yeah,
Exactly.
I'm not gonna say owning, because 30 years, I mean, the bank owns it. But I mean, in reality, he's not putting anything towards the principal.
Correct. And so beyond that, the other thing that we're seeing is people who are selling, buying and moving up because of the same principle. Because right now what they can do is, yeah, maybe buying a new house is a little bit overpriced, but selling now gives you the opportunity to get rid of debt,
Get rid of debt.
get a little bit of a down payment, buy the next house. Yeah, maybe the next house is more expensive, but if you get rid of debt, you're probably living on a monthly basis more comfortable than you were before. I had another customer that we just did that.
And let's say when you sell it off, you didn't do a refinance or whatever, you're probably at a higher interest rate than what you're going to get right now on the newer house that you're going to buy.
Correct. So you're probably in a higher house, and the things that you own, your car, your credit cards, and all this are at higher rates. And all of a sudden, yeah, you're buying a more expensive house, but keep in mind, you're probably financing it under 3%.
Which, let's say you were at a 4 or a 5,
Right.
hopefully, right?
So I'll give you a real scenario. So we have a customer that's doing something very similar, selling a house, and yeah, the new one's more expensive, and his payment, his current mortgage, I believe, is $1,500, and he's going up to $2,000, so he's actually going up. But when he's selling his house, he's getting rid of about $1,000 worth of debt a
Payments.
month. So now he gets this house of his dreams, and with no debt, yeah, the house payment's more, but he's actually living $500 a month more comfortable. So that's one of the scenarios. So that's one of those conversations we like to have is, let's just have a conversation. We did that.
Yeah.
Start with the conversation. Let's just see where it goes. We're not going to tie you up and force you to sign an application or anything. We're just going to have a conversation, talk over numbers.
So that's what they need to do. Like you said, everybody's case is a different situation, and they need a more personalized approach, which is what you guys offer.
And some people go based on how you said what the tia said, with what your neighbor said when they really don't know much. It was their experience.
I mean, it's a good lead, but just don't
Don't go based off of it.
I guarantee you, I can't put on your soccer, right? I mean, it just doesn't fit just because. And so
we can have it amended for you.
the same thing holds true for a mortgage. I mean, the basic principles are there, but just because your TI or your family member did something doesn't mean that.
Like I
necessarily it's the best idea
always
for you.
hear, like nowadays, people saying, is it true you need to give a 20% down payment to buy a
I always
house?
hear.
I'm like, it was in my case, but
So there's some advantages to putting 20% down.
PMI, right?
Right, PMI, you get to avoid it, but if it's gonna, oftentimes, I like to have the conversation of where do you get the most bang for your buck? If you've got 20% to put down, maybe it's a good idea to get rid of debt along the process and put a little bit less down. And we can see the pros and the cons behind doing that. But yeah, that would be another personalized conversation to have is where can you ultimately get you the payments the lowest possible?
Exactly, correct.
Because, whether, at the end of the day, we just want to save you money, whether it's getting rid of debt and a mortgage.
True, true. So, Elaine, we're going to have your contact information. We're going to have your license number somewhere. Where, Karen?
I think right here.
Somewhere there. Okay, so it's going to be there. Where are you located, Elaine? Can you give us your contact information?
Yes, so I am located down the street.
Right down the street from us, even though we moved.
We can almost throw a rock, but it's 2180 South 4th Avenue, Suite F, as in Frank. I actually share the parking lot with Monster Taco.
Monster Taco's right there on the corner. The post office is right across the street from you,
Exactly.
and you're in the two-story building.
Two-story building,
On top.
second floor. Yeah.
Second floor. Our new address, what is it, our new location, Karen?
Hopefully I don't say it wrong, but it's 449 West 20th Place in Yuma, Arizona.
So it's our new location, guys, our new office, 449 West
Awesome
20th
office.
Place. We're located right behind our old building, 2052 South 4th Avenue. Blue Wing Title Agency is located right next door to us. So you'll find us here right off of 4th Avenue, right in front of Dairy Queen, guys. And Elaine is right.
You can see us.
You can see us from his two-story building over there.
I can see you.
We're going to have all our contact information here, our email address somewhere around here, and our phone numbers. San Luis office, 928-627-8000. We have Diana out there. And right here at the Yuma office, 928-783-1000, guys. Guys, we'll see you next time. So, guys, I want to thank Elaine for being here with us.
Thank you for the invitation.
Like I said, I'm sure we're going to get a lot of people that are going to want to contact you regarding refinancing or buying a home. We're going to have your contact information and your business cards here so we can send them right over to you, Elaine.
Appreciate it.
Thank you very much, Elaine. Guys, we'll see you next week on Insurance
sir.
Talk. I could never believe Connie Chung was Maury Povich's wife. Is that good? We good?
Are you recording now?
Are we recording?
We are live.
Live. Hands on the table. Yeah. Espera que vamos a rezar.